Hey everybody, it's Scott with the Davis team, back with another Wow Wednesday, Words of Wisdom Wednesday. Today is a little bit of a blast from the past. We're going to talk about ARMs, or adjustable rate mortgages. They're going to make a little bit of a resurgence. Probably my muddy crystal ball says the next probably 6, 12 months, something like that, until we see a bit of a normalization towards the end of this year or maybe first quarter of next year. But the reason they're going to make a comeback is that rates have been so low for so long, it didn't make sense to do a 3-year, 5-year, 7-year, or even a 10-year ARM if you're not going to see that much of a difference in savings, if any at all. The past 5 years or so, ARM rates have been the same or even maybe a little bit higher than where 30-year fixed mortgages have been. So why bother? Now, it's a different story. We've gone from a mortgage that starts with a 2s to a mortgage that's potentially starting with a 5s in a literal blink of an eye. And it's got folks a little skittish. So now it's time to break the arms out of the bag, dust off that little bag of tricks, and start talking to our borrowers about it. And it's a great conversation to have as a lender and also as a realtor as well, if you're on that side of the ball, kind of finding a little bit more about the why of why folks are buying, or why they're buying up or buying down, whatever it is they're doing. You're creating that bond, getting to know a little bit more about the folks that we're working with. And if you're on the home buying side, you want to make sure that your lender and your realtor understand the why behind your mindset. So if you want to be in a house 3, 5, 7 years, it makes a lot of sense, because we save, I'm going to ballpark here, but you can call it $60 a month for every 100,000 borrowed when you're going from a fixed to an ARM. Again, rough numbers, but if you're looking at a $500,000 loan, you're talking about $300 a month in savings going from from a fixed to an ARM. And real quick, down and dirty about what an ARM is, it's an adjustable rate mortgage. The rate is fixed for the period of the ARM. So if it's a 1-year, 3-year, 5-year, 7-year, 10-year, even a 15-year, whatever that number starts with, that's the term of the fixed loan. So a 5-year ARM, a 7-year ARM, that rate is fixed. Nothing can change. Your rate won't change. Your taxes and insurance may, but your principal and interest and your taxes and insurance will change on any loan, no matter what you get. But on that 5, 7, and 10, nothing's going to change as far as your principal and interest, and you could save somewhere in the ballpark of $200 to $300 a month by doing something like that. And that's going to be considerable savings if you're saving, we'll call it $300 a month, $3,600 a year. $7,200 over 2 years, and 4 years is almost $15,000 you're saving over the course of 4 years. If you extrapolate that for the 7 years of the term of the loan, or even if you're going to be there 10 years, you're talking about tens of thousands of dollars in savings. So it's a great conversation to have with your lender, which is hopefully me, and with your realtor. And realtor is a great conversation to have with the folks that trust you to help guide you through this process. If you guys have any questions about this, I was trying to stay very high level. A lot of information to unpack on an adjustable rate mortgage, but anything you need to know about that, shoot me a line at scott@davisteam.com or give me a call, 703-209-3138. 703-209-3138. I forgot my phone number there for a second. Hit like, subscribe, whichever direction it is, and call me for more information. Have a great week, guys. I will see you next week.